All right, good afternoon, everybody. Welcome to our fourth webinar now on the CARES Act and the COVID-19 relief stuff that has been issued by the government. I think this one is probably the most anticipated one. I know it's by far the one we've gotten the most interest on. It's going to be going over the loan forgiveness application that was released on Friday night. Just before we get started, copies of this presentation and all of our other resources can be found at sereniandassociates.com. This presentation is based on all information that's current as of yesterday, May 18th, 2020. As far as I know, today, no major changes have occurred, but again, this is going to be based off of as of the information yesterday. The information is based on our interpretation of the CARES Act, after reviewing the law, the application, and consulting with other sources. This webinar is for information purposes only, cannot be used to contest any IRS, SBA, or other penalties or assessments. We make no guarantees to your eligibility for these programs, any related benefits, or anything of that nature. I know there are a lot of questions. Lula has been forwarding over all of your questions to me throughout the day. I have made an effort to try to incorporate as many of those as I could within the presentation. I also see the question and answer box is starting to fill up already. We will make every effort to answer all of your questions at the end of the webinar, time permitting. And finally, once again, I just want to thank everybody for their attendance. So, PPP loan forgiveness update and the application itself. I guess I'll start first with my normal shameless self-promotion for those who are new to my webinars. My name is Ed McWilliams. I'm a tax director at Sereni & Associates. I have about over 10 years experience. My industry expertise includes healthcare, financial services, technology, professional services, state and local taxation, and international tax. My contact information is emcwilliams at serenicpa.com. So I want to start off first maybe with a little more of an anecdotal story, I guess, more than anything else. I was putting this presentation together basically last night and this morning, and one of the difficulties I was running into was trying to put this together in a reasonable manner that could be useful for all different sorts of people, because there is a lot of information that really came through on this loan application update and loan forgiveness application, I should say, and trying to do this as best I could. I just realized how really in-depth and crazy this was. So I've tried to make the first part of the presentation a little more general based on some of the new things that we've learned and some of the updates. The middle part, I would say, digs a little deeper into the weeds of some of the newer calculations and our interpretations of them. And then finally, I've tried to provide basically a full comprehensive example of almost a start to finish cycle. Now, again, there's a lot of industry specific or organization specific items that, to be blunt, we still don't have answers to. And I don't know if some of them are ever going to have answers for them based off of just the way things are going. We have to make our best interpretations with what we have and what's coming out going forward. Just on, something I've heard throughout my studying of this, that there was an announcement at an SBA webinar yesterday that they were anticipating there to be a new piece of information updated every day this week. Don't know how true that is, how realistic that is, but that was the anticipation. So one thing I think we all learned from our initial application process was, if we remember, they released that application, and then the night before at about 10:30, they changed that application up. So I wouldn't be surprised if the application we're looking at today goes through a couple changes between now and when it's actually time. Because one thing I want to get clear, kind of just off the bat, there has been no indication as to when you will have to apply or when you should apply for forgiveness. So right now, this application is more about showing the mechanics of it than about having to worry when you're actually going to apply for forgiveness. So as of today, there is no context of when the application for forgiveness will actually happen. So that being said, I want to now hop into kind of the high level key updates that were provided with the release of this application. So I think the most interesting one, the one I think we fielded the most questions on to date, has been for the allowance of a modified 8-week period called the alternative payroll covered period. And I will go over what that really means, how that really works, what kind of potential implications do exist for using that period. This alternative period was allowed for more than anything else to be a feature of administrative convenience, is actually the term used for borrowers. So if I had to classify almost the entire process from start to finish so far, as weird as it's going to sound to say this, is that every single interpretation or regulation that's really come out has been borrower friendly more than borrower unfriendly. And I don't anticipate that to continue, but this alternative method is a borrower friendly provision that is going to, going to help a lot of people, I think, make their life easier. That was the goal here, at least. This application, I went through it, even doing an example just with fictional numbers took me a little bit of time. So I can only imagine when it comes time to do the real thing, it could be very intensive for a lot of people, but that's neither here nor there. So again, we now have the alternative payroll covered window. We also had an expansion, quote unquote, of the 8-week window to cover payroll that is incurred but unpaid. And I'll go over what that really means. But that generally means that any services that were provided by your employees but not yet paid can be paid after the end of your 8-week window and still be an allowable forgiveness. The expansion of the 8-week window for non-payroll costs that were incurred but unpaid. What I find interesting was a little bit of different language than on the payroll piece, and I think that has an implication still somewhat unsettled in the professional community to a degree. One of these things, most people are interpreting one thing one way. My reading of it is a little different than other people's, and I'm starting to see more of that come in, but we'll cover that. Basically, on the non-payroll costs that you incurred, any rent, utilities that you incurred, but you didn't pay, and you pay by the next cycle, so long as it was in your covered period, your 8-week period, you can use that as a forgivable use. I think one of the most popular questions we got starting on March 27th, which was the day after the act actually passed, was what are FTEs? What are FTEs? What are FTEs? So the SBA has now said that FTEs are calculated on a 40-hour week basis. I was surprised it to be that much of a bright line. I think our anticipations were going to be either it would be based on what your normal full-time work week is, or a little bit lower, or at the borrower's discretion. I think some people are happy that there's a fixed number. Now they know what they're playing against, but now there's a lot of people who have well, my full-time week is 35 hours, mine's 37 and a half. How does this impact me? And I think there's some uncertainty when it still comes to that. And I wouldn't be surprised to see more guidance come out when it comes to all of that. There is a confirmation that employee cash compensation is capped at $15,385 for the 8-week period. So one question that I've seen up a couple times had to deal with commission-based people that, I pay the commission 4 times a year, one of which is going to fall in my 8-week period. If I annualize that at 4 payrolls a year, plus the current base salary, that comes out to a different number than everything here across the board. But they kind of said, no, it's a pretty basic, everything kind of goes in the pool together, and you have maxed the $15,385. Another newer thing, maybe one of the only borrower unfriendly provisions, has to do with what they call owner, employee, general partner, and individual owner. So basically a Schedule C owner compensation is capped at the lesser of your 2019 levels or prorated, or 15,385. So you had a lot of organizations who may have applied S corporations and the like, C corporations, that were looking to potentially increase owners' compensation or pay the owners a little more than maybe they had in 2019 in order to use these funds in the way that's most beneficial for them. And now, based on the application, it looks like they're specifically highlighting this. And I think that brings up a fascinating question that comes up in taxes a lot, less here. What about spouses, children, parents that, you know, some owners may have put on payroll in order to try to maximize the funds to them as they try to navigate this? Right now, it only says owner employee, and there hasn't been a lot of clarity with that. And it's become one of the controversial things in the community that I kind of work with, to see, you know, what that really means and how that's really going to impact people. There's still so many uncertainties. There's still a lot of unanswered questions, and then there's some new questions as well. So, you know, a lot of people have questions, and you know, we've been going now for almost 2 months, giving the same terrible answer of we don't know, or there is no answer. A lot of cases we got answers, but some answers still don't exist. And we're still trying to make our best guesses or understandings of what is going on based off of this application so far. So now I'm going to get briefly into the covered period and alternative payroll covered period. The first, and I think the biggest change on the forgiveness application. So your covered period refers to the 8-week period after the loan was disbursed. They clearly use the word disbursed in the application several times. Therefore, our understanding is that means the day that you receive the funds. So if you had a loan disbursement date of April 13th, your covered period started April 13th and on June 7th. If you had a loan disbursement date of April 20th, your covered period started on April 20th and ended on June 14th. 427 would go to 621, 54 to 628. You'll notice that is a 8-week window, 56 days after the date of disbursement of your loan. So that was what your original covered period was. So basically, as soon as you got the funds, the clock was ticking. That still hasn't changed, and despite a lot of media coverage and desire for the window to be expanded, nothing officially yet has occurred that will expand this window after the 8-week period. So, you know, you may be hearing about, oh, Secretary Mnuchin wants to expand it up to 24 weeks and Congress wants to do it. Those are wants right now. Until it passes a law, you're still on the 8-week window clock. So just keep that in mind on what is your covered period. So in order to help borrowers with weekly or bi-weekly payroll, does not help anybody with semi-monthly or monthly, unfortunately, only weekly and bi-weekly payroll, it allows you for payroll purposes only. So again, this is payroll purposes only, allows you to elect an alternative payroll covered period, which allows you to neatly align your payroll with the 8-week period for your payroll costs. So using the same disbursement dates that existed prior. If you had a April 13th disbursement date and your payroll started on April 18th, you could now change your payroll covered period to April 18th, which would expand your payroll period to June 12th. If you had a payroll that started on the 26th, you could now expand it to June 20th. If your payroll started on May 2nd, you could expand it to June 26th. And if your payroll started on the 10th of May, you could expand it to July 4th. So you'll notice the disbursement date and the start of the alternate cover date are now different. They basically push it forward in order to match what your next payroll starting after your loan is. And I think part of the concept behind that, beyond administrative convenience, was one of the more popular questions we would get of, I have to bring people back in order to, use this loan properly and or use it in the way the SBA wants. When do I do that? And a lot of people were mid-payroll or would not be able to do it until the next one started. So that really gives you a little more alignment there. And I think it's meant to make everybody's life easier. I don't know if one is quote unquote better than the other. I think for a lot of people, the alternative payroll covered period will make a lot of sense to line everything up. I think it will help in the calculations. It will help in the use of the proceeds. I think it's a really common sense approach that can really help a lot of people. So I want to just, look, some of the questions that we've gotten, and it's been pretty common. Which is better? Which should I do? There isn't one better than the other per se. It really has to do with convenience. And I think the convenience of the alternative payroll covered period, plus having a longer runway, is just a little bit easier for a lot of borrowers. So that's where I would anticipate we're going. But to the counterpoint, no decisions on this necessarily have to be made today. Even the earliest borrowers are only about 5 or 6 weeks into their window. Their decision point is coming up, don't get me wrong, but you still have time on your side as of right now. So keep that in mind, that you don't have to decide it today. Know the option exists, but know your decision point is coming. Hopefully we'll get some more clarity in the next couple of days about a couple items that could influence your decision one way or the other. So the application itself has an expansion of the 8-week window and talks about payroll cost method. One of the more frequently asked questions that we had gotten as advisors was, is it based on when my wages are paid or based on the period where they are earned? If you asked me, I was fairly certain they were going to be when they were paid. If you had spoken with Ken Serini, he was fairly certain it was going to be on what he would call accrual as to when they were earned. The application has it, and this is the exact quote in there, payroll costs paid and payroll costs incurred. Some, potentially many interpretations have this meaning that prior wages are eligible if paid during the covered period. This would allow, in theory, for more than 8 weeks, but the comp is still capped at an overall 8-week number. So I don't know if that's what they're intending to do. I think they want it to be both, because when you look at the non-payroll costs, they use a different terminology, a different operator. They use or. So I am really thinking that what they really want to intend, and I think the alternative covered period kind of speaks to this as well, that they want it to be when the payroll is incurred, not necessarily when it's paid. Because take an example of a weekly payroll that elects the alternative covered period. You, in theory, would be able to fit 9 payrolls in there. The 8 that you pay during your period, plus the 9th one that was incurred on your last pay period that you can pay in that expanded window. And that goes kind of against the intent of what they were looking for. So I'm not convinced that this means that you can take prior paid wages that are paid during your, but not incurred during your covered period, and use that as an allowable payroll or forgivable payroll cost. I think there's still a fair amount of uncertainty there, and a lot of interpretations that I have read and discussions I've had have said no, because they use payroll costs paid and payroll costs incurred. They're independent clauses, and therefore you can do both. I don't know if I necessarily agree with that based on all of the facts around. So I think there's some uncertainty there as it comes to, how that's going to work. The intention was always 8 weeks of payroll, and I think they wanted to be as incurred, hence the 8-week alternative window. So just, I think that question is going to start to pop up a lot, and I wish I had a better answer for you than that. But I think there's different interpretations all the time. If more clarity comes out, we've been pretty good at pushing information out on a daily basis as relevant. And this is probably not the last conversation we as a group are going to have on forgiveness. Payroll costs are considered paid when the paychecks are written or the ACH credit is originated. So I think that kind of goes in line with what everybody was anticipating as to when they would be paid. Payroll costs are incurred on a per day basis. That is clearly in the instructions. It says that payroll costs are considered incurred on the date the way the services are performed or something to that nature. So to me, that reads as a per day allocation of incurred for people that may not have a payroll cycle that's able to line up with the covered periods or the alternative covered periods, which, I mean, sounds like an absolute disaster to deal with, but I think sometimes you have to play the hand that you're dealt, and they very clearly were costs are incurred on a per day basis. The expansion piece I keep talking about, I just want to clarify, make sure we're all on the same page as it comes to this. Any payroll costs incurred but are not paid during the last pay period, meaning people provided services but they were not paid and you are still in your covered and or alternative covered period and are paid during the next regular payroll, are eligible to forgiveness. And one of the first questions I thought about was, how is like a 2-week lag going to work? Because I'll have it incurred, but then I won't pay that until the payroll after that one comes in. And a lot of companies pay on a lag. So I'm sure more information will have to come out on all of that. That just seems a little bizarre that they anticipate no lag on payroll when a lag is extremely common. So who knows where we're going to go? But that struck me as very bizarre, and I wish I had an answer, but I don't, as to how that would work. Again, just so we're clear, this expansion, incurred means the employees performed the service during the payroll period that kind of laps over your end of your covered period, and you pay them on your next regular payroll. It's as if you paid them at the end of that period. So people were like, oh, should I move up my payroll a couple days to make sure I get it into the end of the covered period? Or should I change my payroll cycles or things like that? All of those have now been, for lack of a better term, addressed. Again, still some uncertainty with how lags are going to work. So, we're definitely going to want to see and hope to see more guidance as it comes along. But I mean, right now, this is better than nothing. If you think about this time last week, we were still really flying blind. And while we're still not flying great, we're less blind than we were as a result. Okay, so just want to go a really quick refresher on the payroll costs, what they are. So again, payroll costs are your cash compensation up to $100,000 per employee on an annualized basis, which would, you can basically take a $100,000 salary and your payroll frequency, and that is how much in payroll costs you are able to use for anybody who makes over that amount. You are allowed, that's going to be your gross pay. Gross pay. The employer portion of health insurance contributions, the employer portion of retirement plans, and the employer portion of state and local taxes on compensation. One of the questions on health insurance plans that comes up is asking about dental and life and disability. Those are uncovered, but they are very much been, every piece of guidance has kind of explicitly said health insurance, health insurance, health insurance. And I think given all of that, those coverages more likely than not probably will not qualify. I could see where dental could potentially qualify, but I think life and or accidental death and dismemberment or long-term disability, I just don't see those as on the same character as to what the intention was here. They haven't given a specific list or a reference as to what you would look for maybe in the Internal Revenue Code to define these. So I think a narrower interpretation, they continually use the word health insurance. So I would use that for the payroll costs there. On state and local taxes on compensation, one of the major questions has, put some examples of that. For our New York employers, which I think are going to amass the majority of the current 545 participants that are in, thank you all for coming, by the way, that's going to be your state unemployment insurance and your New York metropolitan commuter tax. One of the questions that undoubtedly is probably in the question and answer right now, and I think Ken is going through and trying to answer as we move along as best he can, and thank you, Ken, for that, has to do with nonprofits and the reimbursing of the insurance premium. How is that going to work? We don't 100% know how that is going to really be looked at in terms of a tax on compensation. It is a really fascinating question. Ken and I dug into it. We're really hoping to see something in terms of guidance to give us an answer on that. If you ask my gut instinct, it would be probably not, is my gut instinct, kind of based on my reading of the statute of the Federal Unemployment Tax Act, of the entirety of it. But I haven't seen anything definitive either way that would really enable me to give you an answer that makes me feel confident as to how that would work. And I think a point Ken has brought up in one of our articles has been, hey, nonprofits that are self-funded are going to be paying this at basically a 50% rate, all things being equal, once everything kind of goes through the CARES Act. The mechanics of that have been a little suspect in that the organizations will pay the full freight and then get a reimbursement potentially later, which is not ideal. But something to keep in mind is if you're getting a 50% reimbursement later, even if it were claimable, you'd probably only be able to claim 50%. I just don't 100% know, and I don't have enough confidence to say, yes, it's definitely a tax, and I don't have enough to definitively say, no, it's not. You will have to really make that judgment, I think, when the time comes for forgiveness. For your non-eligible payroll costs, these are some common questions that I see coming up a lot. Independent contractors are not your employees, so they are not payroll costs. Workers' compensation insurance is a benefit. It is not a tax. Yes, you're required to have it, but it's not considered a tax in the same way unemployment is, so that is not going to qualify. Your payroll processing fees, ADP, Paychecks, whomever you may use, are a non-eligible cost. And the employer share of Social Security taxes are a non-eligible cost. Once upon a time, when this first came out, some people can recall, there was a question as to, and an interpretation by many people, that you would only be able to use gross pay, not net. And I think that still comes up across the board because a lot of people are, they just have it still in their head. So it has been said in the FAQs and multiple places that it is still supposed to be gross pay, not net. So it's only the employer FICA that is not going to be eligible. Okay, so we covered the alternative covered period, and this is the same example as before, but now just to talk a little bit about the extended window. So if you look here, the last pay period for my top example under my regular covered period goes through the 12th of June, but my covered period ends on the 7th of June, and my pay date is the 17th of June. So that means I can take up to 9 days of my last pay period and apply that towards my covered period and my forgiveness. Again, the SBA has said it's a per day basis based on our readings. On a weekly payroll below, again, my traditional covered period ended on the 14th. The last pay period goes to the 20th. So I have 1 day in my last pay period that applies to my covered period. I can take a 1/7 allocation or a 1/5, however it may work, toward that last payroll. assuming I pay it on the 27th, and that is my next pay or regular pay date after the end of the covered period. So that's what I was trying to get at with, you can extend the window a little bit. I have it visually next, and that was the way that it really clicked for me, and I'll go over that. But if you look at the alternative covered period, I don't have to worry about the mechanics of how many days to pay or really much else other than just my covered period and my payroll period both end on the same day. So it works out pretty well. All I have to worry about is the payday and just make sure it's paid by my next regular payday. So this is kind of the way I was visually thinking, how can I think about this? And this is when I was trying to actually help a client with a question that they had, and I started drawing timelines because I just thought visually maybe it made sense. So I have a loan dispersed on the 20th. So my traditional covered period starts on the 20th, goes through June 14th. I can alternatively, based on my payroll cycles, elect an alternative payroll covered date of the 26th through June 20th. So if you look, the top green line is my covered period. Starts on April 20th, ends on June 14th. In that, I have potentially up to 5 payroll periods. I have the payroll period that ends on the 25th, on May 9th, May 23rd, June 6th, and June 20th. And if you'll notice, my green covered period has an overlap with the incoming period ending on the 25th and the exiting period ending on the 20th. So I can take parts of both of those if I use the traditional covered period. I next have pay dates that are May 1st, May 15th, May 29th, June 12th, and June 26th. One of the questions that we kind of just really talked about was that pay date that's going to be in my covered period that maybe covers the prior. Can I use that? Can't I use that? Some people are saying yes. Some people are saying no. I think it's unclear still, and I don't know if I would go around relying on that at this moment. I think more clarity will come on that. But I have these payroll periods and I have the pay dates, and you'll notice that I have a payroll period that goes past the end of my covered period and has a pay date past the end of my covered period. That is still an allowable item because it's paid on my next regular payroll as of that, at the end of that covered period, services that were incurred. But if you look, we are able to now take the alternative covered payroll period and we can now line everything up with my payroll period. It makes it just so much easier to look at and to calculate and to think about overall, that I think that just makes so much more sense for so many borrowers. It's so much cleaner, no worrying about per diems. Everything lines up and it just makes a neater package. Remember, someone's going to have to review this for your eligibility. The more you understand it, the neater it is for you, the neater it's going to be for everybody taking a look at it. So that's why I think the alternative just makes a ton of sense for a lot of people. Okay, so that covers the expansion of the window and the alternative payroll covered period. I mean, a lot of questions come on that. I think it was the first thing that people saw in the application, and there was a lot of, oh boy, if this is what it's going to be like, I'm in trouble. But I think that was there actually to make your life easier in the end once you have a better understanding of what's going on. Let's now talk about the expanded windows for eligible non-payroll costs. Very similar to payroll, it's going to allow payments of costs incurred during the covered period but not yet paid, so long as paid by the next regular billing cycle. Unlike payroll, there's no references of a per day allocation or anything like that. So I don't think that's going to be something you need to worry about as much based on the initial application that has come out. Inside the application, it has a different wording than the payroll one. This is why I want to bring this up. This says the cost must be paid during the covered period or incurred during the covered period. Remember how payroll was payroll costs paid and incurred? This is paid or incurred. And I think that distinction is crucial when it comes to this, because this to me is a lot clearer that if I pay it during the period, I'm good. If it's incurred during the covered period and I pay it by the next cycle, I'm also good. So that to me is why I was like, you know, the payroll one, it's written differently. Maybe they really mean that it only is supposed to be a pay and incur together because they've had so much emphasis on this 8 weeks of payroll that is in the law and the guidance itself. I think it's really different. And I wanted to highlight that because when I keep getting this question, I keep going back to this particular statement, how different they were in contrast. Your non-payroll costs, they are not impacted at all by this alternative covered period election. So if you use an alternative payroll covered period, that only impacts your payroll costs. And I think that's something that is gonna, I know it'll trip up the borrower somewhere, so I probably said it 3 times. I'll probably say it 3 more times during this webinar, just to really drive it home. The alternative covered period has no impact on your non-payroll cost covered period. So your covered period is still the same for your non-payroll costs. That's maybe the only downside of that alternative period is having to think about 2 separate periods. But given that you have that extra runway at the end of your covered period for costs incurred but not paid, so long as paid in the next cycle, I think there's a little bit lesser of a window of a concern there, so to speak. So just keep that in mind. So because they say it is must be paid during the cover or incurred during the cover, I think there's a lot of potential for back payments to be made in the period. I don't know as much about prepayments. I can tell you that mortgages specifically say that any prepayment of interest or principal is disallowed. They specifically cover the word prepayment within there, and it's not in any of the other payments. So I found that to be interesting just because of the difference in this versus the other ones. That could there be a chance a prepayment is allowed? Maybe. I still think the reasonable proximity idea, that payments that have a reasonable proximity to this 8-week period paid in the normal course of business or similarly is really where you want to be. A lot of this is, I've been calling it the common sense standard, and this is so new to all of us. And a lot of us, and anybody who's had any sort of at length conversation with me has heard me kind of say this, that we're all so used to working with government agencies and fighting government agencies with a strict set of rules that have been around for a long time. And we know the rules of the game, and we can go and look at prior decisions and regulations and guidance and so much history. This is all brand new, brand new. So there's not as much for us to fall back on. When it comes to this, we're all kind of learning as we go and trying to make the best guesses as we can with the information that we have. So now, briefly, a refresher on the eligible non-payroll costs. No more real updates have come on this, so it's basically the same stuff that existed prior. I really hope a little more comes out, but I'm losing my optimism for that by the day. So you are allowed for mortgage interest, but not principal, on real and personal property for a mortgage incurred prior to February 15th, 2020. In the regulations and interim final rules that were issued for sole proprietors, but they are guidance of how the SBA and Treasury are thinking, it states that a mortgage could include on a building and or a truck you use for your business. So it sounds like any interest on any property that you use in the business can be an allowable interest and forgivable interest use for these PPP loans. So just keep that in mind, that I think when we first read it, most of us immediately heard the word mortgage and thought of real property. But it sounds like that's been expanded and interpreted as a little bit of a wider berth. The rent or lease payments, once again, for real or personal property for leases incurred prior to February 15th, 2020. So that is, again, I think a little bit of an interesting statement there, because I don't know if it 100% addresses capital leases. Think about a capital lease, one that's, basically like a mortgage, but it's called a lease for all other purposes. Which category does this fall under? I'd say probably category 1, the substance overrides the form. But leases, a lot of offices have copy machine leases. There may be, postage machine leases, different equipment leases. If you're in the medical field, some of your equipment that you use, it's a little more of an expansive non-payroll cost item because it says real or personal property. Finally, you have utilities for service that began prior to February 15th, 2020. Utilities include gas, water, electric, transportation, telephone, and internet access. That is what the SBA has said utilities mean. A common one I'm getting a lot of is for IT services. I wouldn't say your IT services are a utility, they are a service. One I thought that was interesting was someone asking about server space. I don't think that's a utility, but I don't know if I'd have an argument against you saying that's a lease of personal property, as a server is a computer somewhere that you're leasing space on. I thought that was a real interesting approach when someone asked me that. So potential, I don't know if it's going to definitely be the answer, but you have potential on that. So again, they haven't given much more. This is the same kind of listing that has existed historically. I just wanted to give a kind of a refresher as to what the non-payroll costs are, and maybe a quick update on some understandings that we've gathered over time. We're going on now to the expanded window for the non-payroll costs. Again, no alternate covered period. One covered period can exist. I'm going to use rent as an example here. So I have a rent period of April, May, and June for my office space. So I make my first payment on April 22nd for my April rent. I make my second rent payment on May 31st for my May rent. And I make my third payment for my rent on June 30th for that rent period that basically covered part of my covered period. So I have a 1st through the 30th that was cut off at the 14th. Based on our reading, this allows you to make that payment by the 30th, but with the expanded window, because it was incurred prior to the end of the covered period, you would be able to take it. And I think a question that needs to be thought about here, and I don't know if I have an answer yet, or if they've thought this all the way through. So if I have someone that just fortunately happened to get a loan that the 8 weeks happens to cover maybe the last couple of days, I don't even know if this is actually possible on the math, but it covers the last couple of days of April, it covers all of June and the first couple of days of July, and all of June and May, or I cover part of May and June and into July. Like if I reach into that third month, barely do I really get to use, for one day in that month. I don't think it's really been addressed. I think it's more granular than the SBA more granular than the SBA is going to get. So I don't know if we're going to really get answers. That's why I'm saying it's right now, if I'm thinking about how to do this, I want to think less about the granular, hard bumpers that we're used to using, and rather what the intent and the spirit is. Navigate around the intent and the spirit, and then we can work our way through it, trying to understand otherwise. That's the best advice I can give, is whenever I lose sight of something, I take a step back. What was the intent and the spirit? So that being said, that covers the kind of first part of the presentation, which was more on some of the changes and the expanded windows. I'm next going to get a little more into the granular FTE and forgiveness calculations, and then, time permitting, try to go through a complete sample and still leave plenty of time for all the questions that are there. I know we're trying to answer them as fast as they come in, but that is kind of where we are on that. So the FTE calculation. So the CARES Act had two ways that your loan could be reduced. Number one was if your FTE count has reduced versus your reference period. The other was on salary reductions. So as I said in the intro, it is based on a 40-hour week. If your full-time is less than 40 hours, I don't know if it's necessarily going to impact it, because it's going to impact both sides of your coin. So if you have a 37-hour week, well, your reference period is calculated on a 37-hour week, as is your covered period. So it almost kind of like the same thing on the numerator and the denominator. It may not be this massive issue that could sink. And I wouldn't be surprised, as I said, if this changes to fall more in line with whatever your regular work week is, even if not in statute, if in practice it falls that way. So just, before we go doomsday prophecy on this 37 versus 40 versus 35 work week, think about the practicalities of it to a degree. The FTEs have two methods of calculation. They have a simplified method and the average, what I'm calling the average weekly calculation. Finally, there was always in the law this June 30th, 2020 Safe Harbor. That still exists, but I think one of the most crucial questions still unanswered is how long do I have to keep somebody employed to meet this? Like if I employ someone on June 29th, let them go on July 2nd, does that meet this safe harbor? Like it says, just employed as of June 30th, and we know from the employee count that it was for all employees, full-time or part-time or any other basis as a result. I would imagine that person needs to be an FTE at the very least over the June 30th period. So, that at least needs to be taken into account. But I don't know if there's really going to be this obligation to have someone on for a longer period or a shorter period. And I think I may reference this elsewhere, but just to be clear, because this came up early on, it was a point of confusion for many. You don't have to keep everybody employed through June 30th if your covered period ends. So if your covered period ends on May, 29th, that's the end of your 56-day covered period. That's the end. You don't have to really think about this June 30 unless you want to apply this safe harbor to your overall forgiveness calculation. So there's no need to, it wasn't like a government pays 2, you pay 1 kind of thing to keep everybody employed for the second quarter. That June 30th is just hey, if you made reductions and they are fixed by this date, this particular date, then you are deemed to not have made any reduction. That's the idea behind this safe harbor. I think it still causes a fair amount of confusion. I think it still has a lot of uncertainty. I don't know even how useful it's going to end up being for a lot of people, if I'm being just completely blunt, but it does exist. Finally, this came out in one of the interim final rules, and it was expanded because this has been a very popular question. Employees with a written offer to return that refused, they were fired with cause, or for voluntary exits are exceptions and will be added to your average FTE count. So if you have someone that you fired for cause, and I'll go through an example of that, and you don't replace them, they're not going to punish you for that. They're going to call that an exception and basically add it back to your FTE count. You won't face a reduction for that. So the simplified method. The simplified method says that employees that work more than 40 hours per week, and I'm assuming it is going to mean scheduled, will count as 1.0. All others will count as 0.5. So if you recall, not too long ago, I was saying, hey, what about someone with a 37.5-hour full-time week, a 35-hour full-time week? that really begs the question that if that means that all of those people are a 0.5, if I have no one over 40 hours, that really makes my FTE calculation basically my head count. That's pretty simple, I think. I don't know if that's necessarily going to be the case, but I think that is an interesting thought question that, as I was saying, it affects both sides of the coin either way. Your reference period is calculated under the same methodology. So they're not trying to punish you or be unfair. It's rather just what they've used as this definition. So keep that in mind. I think that's a very interesting question that I was thinking about as I was typing this. What about someone like that? They just call everybody 0.5, and now getting back to the FTE Safe Harbor isn't really that hard, because I could have a bunch of people working 1 or 2 hours that count as 0.5s, and that could just get me back up. It's really an interesting thing. It's not a pick and choose either. It's you do the simplified for everything, or you do the average weekly for everything. I wouldn't be surprised if a lot of people use the simplified over the average weekly. The average weekly looks like kind of a pain to calculate, all things being equal. I don't think there's a blanket answer for that question, though. Just keep that in mind. The average weekly calculation will basically, you calculate the average hours worked per week over your test period, over your 8-week covered period, and or the reference period, and you divide that by the number of weeks in the period. You divide that number by 40, and you round it to your nearest tenth. Again, as I mentioned, you use the same method basically across the board to calculate your FTEs for the reference period, for the safe harbor period, for everything. Once you use one way, you're kind of locked into that. So you have now this FTE reduction quotient. So once you calculate your FTEs and compare it to your reference period, and I will go over a sample FTE calculation next, you then calculate your FTE quotient, which is what your potential forgiveness is reduced by. So you take your average FTEs over the covered period, or divide that by your average FTEs over the reference period, and that gives you your FTE reduction quotient. So in the 4 examples I have below, I had 5.1 FTEs during my covered period, and I had 5.1 during my reference period. I have 1, there's no issue there. I have 4.6 FTEs on my reference period and 5.4 on my reference period, giving me a 0.9. On my third example, I have 16.8 FTEs versus 15.1 prior. I'm way above 1, no question there. A very popular question that continues to come up. There's been no answer given explicitly by the SBA, but it's a question that comes up, and I think it's something that people are maybe, because there's, again, this is the whole thing of dealing with government agencies and your past experiences shaping your current expectations. There's nothing to say that you cannot hire new people or replace the FTEs or have new payroll. That has never, I don't think they're in the position to be going around talking and telling people to not hire new people. That is so contrary to the intent of this law that I would not worry about it. It's all just about FTE count in the end. I think it's beg, borrow, or steal to get there. I don't think they really care about new versus old in a material, meaningful manner. Then my last FTE calc, this example, I had 24.9 in my covered period and 32.5 in the reference period. Everything's rounded to the nearest tenth, and that gives you the reduction quotient of 0.8. So now, when we talk about calculating these FTEs, it is, again, the average hours worked per week and then divided by 40. So my top chart, I have 6 employees that work the following number of hours in each of these weeks. So I have 4 full-time employees, and my full-time week is 40 hours. So one person worked a little bit of extra time because, you know, he's a hard worker like myself, and maybe put a couple extra hours in here and there. But overall, the reason I wanted to demonstrate that was even if you go above 40, it's not going to help. but you have these 4 people here as full-time employees at a 40-hour week. They average 40 hours per week over my 8-week periods. That makes them an average weekly FTE of 1.0 or a simplified FTE of 1.0. For employees 5 and 6, I pulled numbers out of a hat to get to these numbers, if I'm being honest with you. So employee 5 worked over my 8-week period 123 hours, or an average of 15.38 hours per week. When I divide that by 40, that makes him worth 0.4 FTEs. If I were just to use the simplified method, he would be a 0.5 FTE. Employee 6, 214 hours averaged over the 8-week period. That then gives me 26.75 hours over that on average. That's 0.7 FTEs. Oh, look, in this case, he would actually be worth less FTEs under the simplified, but I have to do it for the same method for everybody. So all things being equal on my 2 calculations, I could have a simplified of 5.0 or an average weekly of 5.1. Again, this is just what my covered period is. I would want to compare that to how my base period looks or my reference period to understand maybe which way the better way to go is. Now I look at my reference period. The instructions say you calculate in the reference period, you want the average monthly FTEs for the, I'm using the January 1 through February 29th, 2020 period. You can use June 15th to June 30th, 2019. It is the borrower's option, but the calculation should work the same way. You're supposed to do it under the same context of what is the average hours per week. So in this case, the week of of January 3rd only had a couple work days that existed in there, the 1st, 2nd, and 3rd. Then I have the 10th, the 17th, 24th, so on and so forth. And I calculate here now, same thing. I take my total average, my total hours over the period. I divide that by the number of weeks. That is my average weekly FTE capped at 1.0. For my part-time people, I look at the average number of hours worked per week. I then divide that by the number of weeks or partial weeks within my period, and that gives me my 0.7 and 0.4. Again, it's the sum of all of those weeks' hours divided by the number of weeks in this test period, divided by 40, gets me my FTE. I can alternatively, for anybody that doesn't average 40 per week, I can just say they're worth 0.5. That's the simplified method. I don't know, and I can't say if one is better than the other, but I think you can get from talking, one is a hell of a lot easier than the other. So the reference period is an FTE count per month. I don't want people to get bogged down in the mechanics of this. Any reasonable method, applied consistency in that reference period should be materially fine. Don't let the overall mechanics of this bog down everything. It's, you know, I can feel it as I'm going through the example, as I'm talking through it. I can see that happening very, very easily. So the FTE Safe Harbor. It's, again, it is no guidance as to how long you'd have to keep them past June 30th, and no requirement to keep everybody employed to June 30th. The way the Safe Harbor is calculated, and again, it's pretty mechanical. You calculate your total average FTEs for the period between February 15th and April 26th under the same mechanics as before. You calculate your total FTEs for the period that covers June 15th. So, February 15th. So if you pay from February 10th to February 17th, that week, that is the period you're going to use. You want the one that straddles that February 15th date. If your February 15th FTEs are greater than your average FTEs for the February 15th to April 26th period, then you can apply the Safe Harbor. If you had more FTEs after February 15th, you can't really be in the Safe Harbor because you had no reductions. Look at your total FTEs as of June 30th and compare your June 30th to your February 15th number. If your June 30th is equal or greater than your February 15th number, you're done. You don't have to worry about any other FTE calculations because you've reached the safe harbor. So again, it's a tougher calculation, and for the interest of time, I'm going to have to start moving on a little bit around here just to kind of cover some of the more salient points I wanted to hit and try to take as much time for questions as I can. But some of these mechanics are very just in depth, and you know, there's a lot going on, and a lot of the questions are very technical that we're getting. So we're trying to answer as much as we can broadly to help give you a best interpretation here. The other calculation that came up was the salary reduction calculation. This was the second part of it. This one I find a lot of people, because they use 75%, they're sometimes combining tests. There's two separate tests. The first test is on a broad scale, you have to use 75% of your loan or forgivable loan for payroll costs, meaning payroll, health insurance, retirement, state and local taxes. The second test is, and it's also a 75% test, for any employee that makes less than $100,000 per year on an annualized basis, you have to include the percentage above 25% that their salary has been reduced. And you're comparing it to the first quarter 2020. Now, this was a question that I thought was interesting, and I still think the first quarter 2020 is an interesting use. This thing hit New York in early March. You know, March 12th or 13th was our last day in the office. I think that's the same for a lot of people. Well, that first quarter payroll could be a little depressed for some people, just because there's a half a month in there that they may not have been working during that period because the PPP loans weren't available until April 3rd. So you wouldn't have had, you could have had people that aren't getting paid. So I found the first quarter an interesting use. You do calculate this employee by employee. I know that sounds as brutal as it sounds to say. I have already started looking at it. It is going to be something that is going to take some effort to kind of work through, and that's going to kind of harp on one of the final points that I want to make that, on this overall. The salary reduction calculation makes the FTE calculation look a little easier, if you ask me. I think there's more steps to the salary reduction calculation. They're less granular, but there's more steps to them, I would say. You first have to determine if you have a reduction. You then have to determine if your safe harbor was met, and then you have to determine what the wage reduction actually is. So the first step, is there a reduction in salary? So you take the total wages paid over the 8-week period, you divide that by 8 and multiply it by 52. That is going to be the average annual salary during the covered period. That is the mechanic used to calculate that. You then take your average annual salary from March 1st to March 31st. That is going to be the total wages paid during the first quarter. Basically, take it right off of your first quarter payroll reports. You multiply that by 4. That is the average annual salary during March 1st to March 31st. You compare those two. If the 1A is less than a 25% reduction, meaning it's more than 75% of 1B, you're done. You don't have a reduction. Only if you have more than that do you have to worry about the next steps. Next, you determine if a safe harbor was met, and it's a similar concept to the FTE Safe Harbor. You look at what the average annual salary was for the payroll covering February 15th, 2020. You look at what the payroll was during the periods of April 15th to April 26th, 2020. They haven't said how to calculate it, but since they go on a per day basis on the payroll incurred, that was the way I thought about it, but I think any reasonable method will probably be fine for this calculation. You compare your average annual salary on February 15th to the one on the February 15th to April 26th period to see if you first had a reduction there. Once you have a reduction there, if you have a reduction there, you compare it to your June 30th, 2020 salary. And if you have corrected the reduction by the June 30, 2020 salary, you are in the safe harbor and you don't have to take any reduction into account. If you don't meet the safe harbor, you move on to step 3. You determine your wage reduction. You take the amount in 1B, which is your first quarter salary annualized, times 0.75. You subtract out the 8-week average annual salary that you calculated in step 1A. For an hourly employee, you put the average number of hours worked times the average hourly wage calculated in 3B times 8. So again, hourly and salary are done a little differently. I've been focusing mostly on salary ones because I think that's going to be far more of a common scenario. For salaried employees, you multiply the amount in 3B times 8 and then divide it by 52. So I'm going to go now through an example of one because I think that will cement this calculation. And again, it's very granular. It's very detailed. It is something that we're going to have to work with to help figure out the best way to calculate this for everybody. I'm trying to more stress the principle of what's going on here than the actual mechanic itself. A salaried employee was making $80,000 per year and reduced to $55,000. So their average wages during the 8-week period were $8,000 divided by $8,000 per week. 52 weeks is $52,000 per year. It was supposed to be $1,250. I must have made a mistake. They were reduced, but the average annual salary in the first quarter was $20,000 times 4, $80,000. So they have a 65% reduction. Again, apologize, it was supposed to be reduced to 55,000, not 52. So I now, again, I have this reduction here to 65% of this prior salary. That's the point that really needs to be hit there. The average, the salary or wage paid at February 15th, 2020 was $80,000. My reduction occurred after. I calculated the average payroll, made it up more or less, for the period between February 15th and April 26th to be $9,593, which is $133 per day, times 365 days, is a $48,600 salary. So I clearly have a reduction here. That's a false item. So now I have bumped this person back up to $65,000 as of June 30th. So I have them up, but not all the way back to their February 15th. So I failed the safe harbor calculation. The point here is I would only pass this safe harbor if that 25,000 was back to the 3,077 and they were up to $80,000 in salary. Finally, I now look at the wage reduction. So I multiply the amount in 1B, which is my $80,000 first quarter salary, and I subtract out the amount in 1A, my 8-week annualized, which is a negative 8,000. I multiply the amount in 3B times 8 for my salary, and then I divide it by 52, and that gets me to $1,231 of a reduction. There's other ways to make this calculation work. This is the way they put it in their example, so that's the way I use. Just as a quick example here, if I can meet the safe harbor, right? I wanted to show how that would look. There's an $80,000 salary prior. Still, during this period, I had a reduction of down to $48,633, same fact pattern as before. But for June 30th, I'm now back up to that regular salary. That prior reduction doesn't really impact everybody as much. It has no impact, and I have no reduction on my forgiveness calculation. All right, so just want to go over, I'm going to skip the documentation for now. Here's the link for the application. It has 4 components: the forgiveness application, Schedule A, the worksheet, and an optional demographic form. But this is where the link for the application itself is. I want to go over briefly the required attestations on this application, because there was a lot of questions about attestations after the fact on the original application. A lot of people kind of overlooked them, just saying, yeah, you know, whatever. So I don't want to have a repeat of that. But you have to attest that the amount for which forgiveness is requested, you use to pay eligible costs, that you have included all reductions, that you do not include non-payroll costs of greater than 25%, and you do not exceed 8 weeks worth of 2019 compensation for any owner employee. That you, if you willingly use it for unauthorized purposes, the government may pursue recovery and/or civil and criminal damages. The borrower, and I want to emphasize this, has accurately verified payments for eligible payroll and non-payroll costs. Remember, the original application was a borrower certification. Well, history is repeating itself here. You will submit the documentation for payroll costs, existence of obligations, and service prior to February 15th. That all information submitted is materially correct. A false statement is punishable under law with fines and imprisonment, and acknowledgement that the documents submitted are true and that more may be requested. So the application itself, these are how the calculations work. I kind of pulled it into one slide. I have the breakdown of the application itself, but I think that's not going to be the best use of our remaining time, so I'm going to forego that. The application itself, line 1 is where you put your payroll costs, which you're going to get from the Schedule A. Lines 2, 3, and 4 are where you would input your mortgage interest payments, your lease payments, and your utility payments. Lines 5, 6, and 7 are where you would input your salary and wage reductions, again from Schedule A. Your line 6 is where you sum up your entire potential forgiveness amount. And then line 7 is where you put the reduction quotient. From there, you have your 3 potential forgiveness amounts. You have the modified total, which is your line 6 times line 7. You have your PPP loan amount, the entire amount that you got, and you have your payroll cost, line 1 divided by 0.75. The lowest of those 3 amounts is going to be your forgiveness amount. And I'm going to go through an example of this calculation. Schedule A, the other key component here, there's Schedule A and the Schedule A worksheet. The Schedule A worksheet is where you're going to list out all of your employees, their cash compensation, their average FTE count, and any salary reductions. There's 2 tables. Table 1 for anybody that made less than $100,000 in 2019, and Table 2 for someone that made more than $100,000 in 2019. So those are 2 tables on Schedule A. We'll go over those. For lines 6, 7, and 8, you put in your non-cash compensation, again, employer health contributions, employer retirement plan contributions, and employer state and local taxes. Line 9 is where you put in for the owner employees, self-employed, and partners. You then sum up to your payroll costs, lines 4, 1, 6 through 9. You then put in for your FTEs, the FTEs during your reference period, the FTEs during your covered period, and your reduction quotas. So this is the application A, or Schedule A, that exists in the application. Looks like this. Again, it's the same thing summed up. They give you this worksheet within the Schedule A. This worksheet is going to be your main work area to figure a lot of these things out. So you have your employee's name, the last 4 of their SSN, that's their employee identifier. The cash compensation is the gross pay for 8 weeks, capped at 8 weeks. Nobody on any schedule here should be above $15,385. Here is where you put their FTE calculation, and here is where you put any salary reduction calculation. If you recall, we discussed there are exemptions for people who did not want to return, who were fired, or who quit. That is where you would put them in to add them back to your FTEs. You then do the total for cash compensation, average FTEs, And for your salary hourly wage reductions, that's box 1, 2, and 3. Box 1, 2, and 3 correspond to box 1, 2, and 3 here. It says it on the application itself, cash comp box 1. So it actually will tell you where on that schedule you need to put these. Table 2 is for employees making more than $100,000 per year annualized in 2019. So you have your employee's name, the last 4 of the SSN, the cash compensation, and the average test FTE. Notice, no salary wage reduction. That still exists. If you have someone that makes over $100,000 per year annualized in 2019, and they have a reduction, you don't have to take that into account. This worksheet is for your benefit provided by the SBA in order to help your calculations. Okay, so now I'm going to run through an example, give a couple of quick thoughts at the end, and then I will be around for questions as long as they are here. So we have an eligible borrower who borrowed for $149,087 on a PPP loan received on April 24th. They pay their employees biweekly, starting on Saturdays, ending on Fridays. The payday is on Thursday or 6 days after the end of the period. Their last payroll period prior to this ended on April 17th, 2020, and was paid on April 23rd, 2020. This is how Acme applied for their loan, just as a very simple recap. 10 employees, compensation capped at $100,000. This is the company's annual retirement match, their annual contribution to health insurance, their state and local taxes, which is going to be the unemployment. That's their total payroll costs. That is what the loan was. That is how we got to this loan calculation. At this point, most people have their loans, so I don't think that's as relevant, but just to have it in there for completeness. Acme let go of employee 6 at the end of March 2020 as a result of slowdown from their COVID-19 operations. So employee number 6 has been let go. Employee number 7 was caught stealing from the company food drive and was terminated with cause in April 2020. So you definitely have an employee that you caught stealing and now he's terminated for cause. Neither of them have been replaced. Employee 1 has taken a voluntary pay cut of 25%. Employee 2 has taken a 30% pay cut with no change in hours, and employee 8 had their salary reduced from 40 hours to 24 hours. So using a real example here, the loan disbursement date was April 24th. My covered period is April 24th to June 18th, 56 days. My alternative covered period to match up with my payrolls is May 2nd to June 26th. Acme is going to elect to use the alternative covered period to align with their pay dates for convenience. Our payroll data in total here shows us with biweekly payrolls of totals of these amounts throughout the 4-week period, and these amounts that were paid for retirement match, health insurance, and state and local taxes. You'll notice employee 6 and 7, employee 6 who was let go, employee 7 who was fired. Their first quarter wages, no wages during the period, no retirement match, health insurance, state and local taxes. You'll notice that employees 1 and 2 have a reduction in their salary. Looking at my FTE calculations for Acme. For my covered period, I don't count employees 6 and 7. They did not work. I have full-time employees for my first 5, all at 40 hours per week. They are a 1.0 FTE, whether looking at average weekly or simplified. For my 8, 9, and 10, under the average weekly, they would be 0.6, 0.4, 0.4, taking their total hours over 8 weeks divided by the number of weeks divided by 40, or simplified method is 4.5. Acme is going to use the simplified method just for future reference. Now, on my reference period, even though 6 and 7 have been let go, I still include them in the calculation in my reference period. In my reference period, I had 9.0 FTEs based on this calculation. So now I have to worry about for employee 2 their salary reduction calculation. In this case, during the 8-week period, their salary was reduced by 30%, or an annual of $66,500 when they were paid based on the first quarter, $95,000, or 70% of their prior salary. So again, I calculate what it was for the February 15th payroll. Things were still good then. They were paid $95,000. I calculate the February 15th to April 26th prorated at $12,423. Again, that's just based on, it would be a calculation through and through, but the run through it is probably counterproductive. Point being, the average annual salary has had a decline. So I am able to move on. I was able to increase his salary back to $3,250 over 26 weeks for an $84,005 by June 30th. So I bumped him up, but I didn't bump him up all the way. So I don't meet the safe harbor, so I have to calculate his salary reduction. I take 75% of the $95,000. I take the 8-week, reduction in the 8-week annual, the 66.5 right there. I multiply it by 8, divide by 52. The math works on it. This is the SBA way of doing it. I don't know if I would do it this way, but I can tell you this is the way the SBA has it, and the formulas in here are working. So I wonder if I read it wrong. I wonder if I have the wrong info here, but this number itself is right. That I can tell you. So now, my Schedule A, what my Schedule A is going to look like. I have cash compensation of these employees for $53,000. These all make less than $100,000 per year in 2019. Employee 2 had that salary reduction. Employee 1, who made more than $100,000, he had a reduction, but since he made more than $100,000, he did not need to be put into Table 1. And I have my FTE exception of 1 here for the employee I fired with cause. So now let's look at my Schedule A calculations. I have my cash compensation, $53,173, 6.5 FTEs, a salary reduction of $731. My Table 2, cash compensation of $14,000 and 1 FTE. I have my employer health, retirement, and state and local taxes across the board here. Note there's no owner employee or self-employed. I add those up. Here's my FTE reduction quotient. I now fill in my chart, my payroll costs, my rent payments, my utilities. Here's the reduction. This is the sum of everything. I take my quotient, multiply it times the amount in line 6. That's my modified total. I have my PPP loan amount, and I have my payroll cost. I take the lowest of these three amounts, or 88,617. So I'm going to get into questions now. I went a little longer on some areas. I apologize. So I mentioned this in the beginning. The initial PPP application changed after the initial release. I would not be surprised to see a repeat of all this. There's a support for increasing that 8-week covered period. I don't know if it's going to be too little, too late in order to do that. I mean, a lot of people are 5 weeks in already on this. Does increasing it really help? I don't know. Took me an expedited hour and 25 minutes to get through, skipping some areas, might I add, to try to give a basic explanation of all of this. I really wonder if there's going to be a safe harbor or deemed forgiveness for loans of a certain size. I think give it a couple days where people start to take a look at this and realize how in-depth of a calculation this is going to be, and it's supposed to help businesses. And you're going to start hearing some feedback of this is too complicated for many businesses. And knock on wood, hopefully loans of a certain size are automatically forgiven. Nothing truthful there, nothing there. Nothing there that I can say is definitive. It's maybe a hope. Is there more relief coming? Potentially. I don't know. Hopefully there is. And it looks like the unused or unforgiven amounts will be converted to a low cost of capital loan. I have had concerns, anybody who's spoken with me has heard this, that I could have seen the FBA saying anything you didn't spend in the 8 weeks, you have to return within a certain number of days. My concern for that is decreasing as the days go on, because I haven't heard anything about that. but it is something that definitely exists for potential. So just something to keep in mind there. So that said, I believe you were all emailed a copy of this slide deck prior to the presentation. If not, I think it is on our website. That being said, there are, geez, well, thank you, Ken, for, I saw that number not going down. I assumed Ken wasn't answering, but he answered 89 questions already, and we still have 190 to go. So I'm going to start mostly just answering these live as I go along. And then we'll work our way from there. So.
Ed, I only have 157 questions showing, so.
Oh, okay. I guess maybe the first 10 that were in when you weren't there, Ken, haven't repopulated prior to that. So if you have 100 employees, you have to list each one individually. As of right now, the answer is yes. Do remember the Schedule A worksheet is for your benefit. It is something you need to retain. I glanced over this in the documentation area, but the Schedule A worksheet is for the borrower's records. It doesn't go with that application. So you need to have available the calculation on 100 employees individually, but you may not need to precisely use that SBA form, although I would probably recommend overall that you do. If we do not meet the 75% payroll amount due to other circumstances, will the rent or other stuff be on the same ratio? You keep the same ratio. They basically have it ratioed up. It's not a cliff. So if you look on the calculations here, you take your payroll cost divided by 0.75. So that allows you to use the it allows that any amount that you use for payroll costs, they will give you up to that amount at a 75-25 ratio. So if you overspend the rent relative to payroll, you're only going to be forgiven the amount that's in lockstep with your payroll presentation. Can we use Excel spreadsheets as the documentation and attachments? I'm sure you can use it for the documentation. I am unsure if you'll be able to use it for any of the attachments. I think the SBA is going to want that on their particular forms. But I mean, for any of the ones that we're going to be assisting or helping with, I'm definitely going to be doing on Excel. So I can't imagine Excel is not going to be an allowable way of doing this. Okay. As a school, when we close for vacation during February, when we figure out the average hours as they get paid for this, you would figure out the average hours if you got paid. Any kind of leave or anything like that would count. So no question on that one. Can we get this recorded? Yes, this will be recorded and will be put it on the website. The slides are available on our website as well. So. The payroll period runs from February 7th to February 18th. Would you use this payroll to determine the February 15th? Yes, you want to use whatever payroll, whatever covers the period of February 15th is what you're looking for. The proceeds, again, it starts on the same question has to do if you don't get proceeds till 5/4, what happens? It's just a shifting of your clock outwards. It's the same clock, just shifted outwards. You have the covered period and alternative covered can work the same way. Okay. Can we prepay summer wages or stipends? It says for payroll incurred, so I doubt a prepayment of wages will be allowable. Dental and life insurance are payroll costs. I'm unsure, again, I can't definitively say, but everything references health insurance, not other forms. I think dental probably will fall under dental and vision, would fall under that realm. I don't think life insurance will. any guidance if the headcount increase between application and approval. So that doesn't really matter as much. The test has to be for your covered period is really where it matters. The headcount you gave on application and or approval doesn't really have any impact. That's why when people kept asking me about that, I was like, it's not as big of a deal. I wouldn't worry about that as much. If we reimburse employees for their transportation and telephone costs each month, can I include it? I think if you are on a non-accountable plan, and therefore it should be considered as salary and wages, then that would count. If you're on an accountable plan, I would be wary that you would be able to put the reimbursement through unless you were doing it historically as part of your operation. And even then, I don't think their intention was to have those count as covered utilities. What about security monitoring? I don't know if that's going to be a utility, but I highly doubt that will be.
Ed, you want to go through the chat questions? It's a little bit easier for me to answer the other questions. So if you want to go through the chat questions first, I can then come back to the Q&A.
Okay. Are sewer costs allowed under utilities? Yes, they are. Is there specific language in the recall letter for offers to employees to come back to work? We have been advising that you make a written offer, give details as to what the offer is, discuss all the customary items that would be in there, and try to confirm that they received it in some manner. But otherwise, no specific language per se. Is interest on an existing line of credit paid during the covered period forgivable? No, it is an allowable use, but not a forgivable use. If we pay more than 0.75 of the loan in salary, can only 0.75 be forgiven? No, that's the floor, not the ceiling. So they would, in a perfect world, they'd love to use 100% of it for salary. If an S Corp owner had no payroll in 2019, can we not use payroll for the covered period? We lost management staff and have no other option. So I think that is a very interesting question. Based off of the guidance we've gotten so far, I would say the answer to that is likely no, that if the owner was not on payroll prior or had no 2019 compensation, because it said it has to be capped at that if they weren't there in the past, you won't be able to put them on in the future. We have an employee who was a hire in the last quarter of 2019. Her full salary is over 100K per year. Well, which sheet would she go on? She would go on table 2. It's a 100,000 per year annualized. So if you have someone that you hired in the third quarter and their payment on an annualized basis will be more than 100,000, they would go on table 2. Are commissions and regularly paid bonuses counted as payroll costs, and can they be used in the calc amount for loan amount determination? They can be used in loan amount determination. Commissions have been explicitly stated. I would say regular bonuses in the ordinary course of business, whether it's sales incentives or things like that, are probably fine. I would be wary of trying to put in new bonuses during this period to bump up people's pay in an interesting manner. Bonuses are never stated anywhere, but it does say other forms of compensation. So we've always kind of thought bonuses fall into that category.
One thing on that, Ed, if you are paying combat pay or some other compensation that people are getting an extra to their normal salary, and it's justifiable under the pandemic. So people who are working on the front line or people who are putting in more hours because they have to do things through teletherapy or tele-education and they're working more hours because of it, and you do give them extra money for it, that could potentially qualify because it is justifiable.
Yes, I would agree, 100%. That's that was. I know it's one of the questions that was in the chat when I saw pop up early, so it was one I was going to hop into. But you already took care of that one for me. Yeah. If you're increasing people's pay for hazard or combat pay, as Ken is calling it, kind of based on the facts and circumstances of this pandemic, I very much think that's going to be an allowable and good use. So I would recommend that that's perfectly fine. No issues there, as long as it's reasonable and, again, passes a common sense test. If I have 4 twice per month payrolls during my 8-week period, can I use the total count from those full payrolls, or do I need to calculate 8 weeks worth only? I don't know 100% the answer to that because of the way they wrote payroll costs incurred and paid. I take the interpretation that they want it to be 8 weeks of incurred and paid. So you would basically take the first payment, the amount that covers into the incurred period, and the last payment, the amount that covers into the incurred period, and rate it pro rata. I think that's the most conservative approach. Some other people are taking the interpretation that payroll paid just means paid, independent of and incurred. So I don't 100% know your answer, but that's how I think they want it to work based on my interpretation of the application. Okay, yes, you do have to do it is a per employee calculation. And employee on maternity leave and not being paid anymore, can I still include in the FTE? They haven't covered a maternity leave scenario. That's one I kind of noted was missing as well, an unpaid FMLA leave, how that would work in the FTE. My instinct on that is going to be no, but I wouldn't be surprised if that's going to be allowed. I don't think they've really covered that yet. Again, the exceptions allow for voluntary leave. Could you call the maternity leave a voluntary leave? I think we're getting into some political family leave issues there if we start going down that path. But I think if you were to try to argue it would be a voluntary leave under that, I could see that argument working. So that's not one that's been 100% clarified yet. If there were no reductions in hourly costs, but total money lower due to people working less, then is there a salary reduction? Typically, if there is lower money due to people working less, then yes, that will be considered a salary reduction. What if you give part-time employees a chance to work, but they didn't work, even if they are still employed by June 30th? So if you gave part-time employees a chance to work, and you gave them a written offer that they refused, that is considered an FTE exception and will not reduce your FTE headcount.
Ed, quick question. Would you
Yes.
consider trash collection or garbage pickup or refuse removal a utility?
I would say probably not.
Right. That's my feeling too, but I just wanted to hear what you thought.
Yeah, I would say, I think utilities is a pretty narrow definition until stated otherwise. They kind of gave you 6 categories. I think if they wanted to include that, they would have included building services. Because then, I mean, that now, begs the question, is a cleaning staff a utility? Is this, you can really go down a rabbit hole when it comes to that one. Okay. If an employee leaves on their own or for cause, they will be added back as an FTE. That won't hold true for their salary though, but you won't have a salary reduction. You still won't have any payment of salary for that, but it's not as if you're going to be hit with a salary reduction. Because our
Someone's asking about Amazon Web Services.
So that's what I was talking about on a potential personal property lease. I don't think it's a utility, but I think there's an argument to be made that you're leasing server space, which is a piece of personal property. I think it's a fascinating question. I don't know if we're ever going to 100% get an answer on that one. I don't think it falls under utility, but I think it very well could be a lease of personal property. The only opposite point to that, and this goes back to my tax brain, is when you look at state income tax nexus, one of the areas that's been emerging for a while is, does lease of a server in a space give you nexus? Most places had answered no, some are moving to yes. And so, you know, some people look at it as a lease of a personal property, some don't. So I could see the argument, but I don't know if that one's going to be ever fully clarified. I think it's a case by case determination there. Does hours work include PTO time paid during the period? Yes. Can you pay bonus during the covered period? I think we kind of touched on that, but just to be clear, they haven't explicitly said bonuses are allowed, haven't explicitly said bonuses are not allowed. I am erring on the side of, unless it's a justifiable bonus with a good reason, like hazard pay or combat pay, I don't think this was intended to pay bonuses to get employees up there. So any employee that's on a paid leave, paid family leave, I think that was addressed, but I know that anybody on paid leave, assuming it's not a FFCRA, the first Coronavirus Act leave is allowable. In terms of counting them for FTEs, I would count them as to what their normal average schedule would be if they're on paid leave for that. Our payroll in 2019 was higher than in 2020 due to high salaried employee leaving. Can we give bonuses to people, even if it brings them over the 15,385? I wouldn't advise doing that. Disability or maternity leave, do they count as an active employee? I would think that could potentially go under the voluntary leave, but it hasn't been specifically addressed yet. Do I count myself as an employee if I am the owner? The answer to that is no, you don't count in the FTE count for owner employees based on where they sit on the new line for this in the forgiveness application. Will PPE purchase for the next 6 months or a 6-month cleaning contract in the central workplace for disinfectant? Ken already did an answer on that. Okay. Do we need to back out the emergency leave time provided by the CARES Act? Yes, I believe you do. What's up, Ken?
Yeah, the PPE, I didn't answer. You were reading it. I should have let you finish reading it before I said answered live. But
okay. The PPE and or cleaning service, there's nothing in the law, despite the common sense approach that you would think that would be in there. Nothing in there allows for anything for use of PPE or cleaning services to allow that to go through. So the answer is no, that's not a forgivable use. We have a truck loan, not a lease, so the payment's covered. The interest on the loan is an allowable and forgivable use. We are renting space during temporary construction project. Does this rent count? What about storage also being rented? I haven't really addressed that, but I think both of those looking at how the statute is written, would be allowable. If over 75% was spent on salary, why is only 0.70.5 allowed, a lower of 8, 9, or 10? Because that's the floor. That's what they're trying to say. You have to spend at least 0.75. You get the lower of those three amounts. So if you spent all 100% on salary, you would still be fine. It's divided by 0.75, not times 0.75. So that would increase it rather than decrease it. I understand that I can use refusal to work for PTE purposes, but if they weren't PTE for, I don't quite understand that question. Why are you penalized on the salary reduction? You only get penalized on the salary reduction in the event that you pay somebody and you pay somebody less than you used to. The forgiveness application will be submitted to your lender and not to the SBA itself. I believe the lender will forward it over to the SBA.
Hey, there's a question here. Since we are a school and all of our teachers incurred their salaries by June 30th, but we spread our payroll over the summer, can we pay their summer salaries on June 30th to maximize loan forgiveness? So this has popped up several times. I think the answer here is that if you're going to try to push the salary forward and pull it into your 8-week period of time, I'm not sure that all of it would be an allowable.
It needs to be paid by the next regular payroll period. So I would say that one's going to be a no, because you may have incurred it, but it's not paid by the next regular payroll period. That's where I think that one falls apart. Are there penalties if you let an employee go and hire 1 or 2 employees to replace them at an equal gross salary? Not that we're aware of. Everything's based off on gross FTE counts and gross salaries. So that should not generate an issue in any way. A payment, workers' compensation is not an allowable payroll cost. Even if it's paid through ADP or whomever ADP is doing it as a paying agent, it's not going to be an allowable allowable payroll cost for PPP purposes. Hi, Vicky. Even an S Corp, the owner is not considered an employee. So based on the way they put this application out, one of the $64,000 question, since this application that's come out, I don't know why people are harping on this one as much as other ones in the Twitter groups that I'm in that kind of discuss this stuff, but they are saying, and based on how the application looks, an S corporation owner employee does not count on both sides of the FTE calculation. If I pay hazard pay to essential workforce, will it have to be paid in a lump sum prior to June 30th? I would recommend you increase their period-to-period salary as soon as possible, and it has to be paid in your covered period, not by June 30th. So if you're already halfway through your covered period, I think a retro pay, so long as it's reasonable, isn't out of the realm of possibility, but you should look to pay it period to period throughout if you're going to be using some sort of hazard pay. Is bank interest allowable and forgivable? Bank interest is allowable but not forgivable unless it's under a mortgage or something that is secured by a piece of real or personal property. One of our employees refused to return to work. Can we use his salary to give the remaining employees a bonus for hazard pay? Those are independent events. You can pay your employees a hazard or bonus pay, or sorry, hazard or combat pay, so long as it is reasonable under the circumstances and is not abusive in any context. So, you know, that's kind of the point we're making here is if you're going to do it, you can do it, just don't make it outlandish or unreasonable. We pay our annual 401k Safe Harbor payment in the year after incurred. We have not yet made our 2019 payment, normally paid in October. If we pay the 2019 during the 8-week forgiveness period, does it all qualify as forgivable? Or does the amount accrued during the 8-week period that is only going to be paid in 2021 count? I think that is a terrific question. It is one I have tried to seek the answer on myself because I don't 100% know how they're going to treat that. Again, it's the payroll costs incurred and payroll costs paid. How that's going to be interpreted, what that's going to mean, how the retirement is going to mean. I think the intention is to allow for periodic contributions that need to be made and are paid within the 1-week period. But if you do it all in one lump sum, I think the 2019 one goes into the 2019 calculation, and the 2021 one, or the 2021 that you pay in 2021, is going to be paid too far out in that period. I think if you want to try to do it, you would try to calculate it for the amount that was incurred over the period and pay it accordingly. I think trying to do it in the lump like that is not going to work very well. It's something we didn't touch on, but yes. Is the EIDL advance deducted from your credit for forgiveness regardless of what you use it for? I was under the belief the reduction is only used for a PPP loan item. If we use it for product purchases, it will be left out. Basically, the advance is taken off the top regardless of what it's used for. Any EIDL advance, not the full loan, but the up to $10,000 advance is taken off the top. They will just reduce it without asking how you used it, correct?
Hey, you want to talk a little about transportation utilities?
I'm sorry, what was that, Ken?
Transportation utilities.
So they have referenced transportation as a utility that is allowable. Their references have been largely related to vehicle businesses, like things like delivery trucks and things like that. So I think you want to look at it from that regard as to what a transportation utility is. So if you're, you know, if you have some of these social service programs that have vans or things like that, that could be a transportation utility. If you have work trucks, you know, for doing installations or whatnot, that could be a transportation utility. But overall, you know, I think that's where they're going with that. What about PTO time during the covered period? Forgivable? Yep, no question on PTO. End of June fiscal year, we pay out unused PTO. There's a lot of, since people can't go anywhere, is that allowable? I would say that any PTO that was incurred and paid out in the covered period could potentially be allowable. But if you're paying it out in June 30th, after June 30th, you're actually once again going to fail the incurred but not paid during the regular payroll test. Paying out PTO, again, I think that's a little bit of a gray area as a result of all of that. So I couldn't necessarily tell you 100%. I'm kind of lost about half the audience here, but just to, on a high level, the one thing I always stress, and I said at least once during the presentation, the goal, what was the goal of this program? It was to keep everybody on payroll for as long as possible by giving a forgivable loan. So the real intention is they want to kind of have you keep people on payroll, not always looking to try to find new ways to use money that came in. And I think that has to kind of guide your visions here. There's not a lot of bright line, yes or no guidance or, you know, historical things that we can look back upon to really answer some of these. We're really trying to make our best guess as a result of everything that's out there. There have been no special dispensations given for anything in the restaurant, as far as I'm aware, for the FTE forgiveness and or salary forgiveness, but you bring up a great point about there being a minimum capacity. I don't, you know, again, they haven't given anything special for restaurants for that otherwise. I think that's a terrific question. For trucks as a utility, what can be included? Gas, tolls, insurance. They haven't really given a lot of guidance as to that. I would say I think the only thing that was mentioned was the cost of gas for the truck itself was mentioned in the IFR for Schedule C or in independent contractor filing. So I would say gas is the only one absent anything on that. I don't know if there's going to be a chance. The Q&A was answered mostly live, so I don't know if there's a way to export it, but I can give it a shot.
Ed, what we're doing is we're copying and pasting the Q&A questions. So we're going to try to see what we can do about getting them to be able to be distributed out to everybody.
Right, but if we answered most of them verbally, then I don't know how that's going to work.
And they'll get those by rewatching.
Oh, okay. All right. Yeah. I've been hitting answer live on the ones I'm answering. So if I'm taking some away from you in advance, I'm sorry. How do you count hours for FTE? I would count hours based on any reasonable method. So if they're a salaried employee, it's whatever their expected work week is, assuming they made it for that. I don't think there's going to be a strict hours count per se when it comes to that. Yeah, she used gross pay to calculate salary. Would top hat lump sum payments into a 457B count as a retirement cost? I think it depends if it's going to be a qualified or a non-qualified plan. I don't know all the specifics of the top hats and the 457. Ken, do you know a little more about those? Are they qualified or non-qualified plans?
I think a lot of the 457s are non-qualified.
The non-qualified plans. So, you know, I don't know if that's real. They haven't really given much address as to what a retirement cost is overall. So I would say it's probably going to be a more narrower interpretation of that. I think given the nature of that plan and the benefit and all of that, I don't think that would be a retirement cost, but that's a little more exotic one that I'd have to really think about more to be able to give you an answer. If you hire a part-time employee now, do they have to work until June 30th to count towards the FTE? No, if you hire a part-time employee now, they count now in your covered period. Again, June 30th is only the safe harbor of if you have the same FTEs that you had prior, then you would be able to appeal yourself to the safe harbor and not have to worry about the FTE calculations. Property tax is not a non-allowable cost as a double negative. Property tax is not allowed to be used for a PPP loan. I'll just say it easier. Should you estimate 8 weeks payroll if you pay monthly or semi-monthly? The way that I would do it is, again, they say it's on a per day basis for the incurred and paid. So I would look at it from that way based on the payroll periods that exist. So I think, any reasonable method will probably be allowable, all things equal, but the closer to exact you can get, the better you're going to be. And it looks like they do it on a per day basis. We have 3 trucks, 2 are registered in employee names but used for business and personal family business. Can we use money for that? I would very much say that any trucks, any transportation costs that are being used should be in the business name and through the business through and through. I would not be mixing business. I wouldn't go cross platform there, so to speak. If we are using 45% of the loan to rehire staff but meet our FTE requirements, will the expense be forgiven? Will the remaining loan balance become a loan? If you meet the FTE requirements and you have no salary reductions, anything you spend on an allowable cost will be forgiven. Any remaining balance will become a loan, as to our understanding right now. Is storage rent considered rent? I believe under the circumstances, storage rent will be considered rent. Do utility bills need to be prorated, or can 2 months be submitted? Based on our interpretation and the reading, I don't think the utility bills need to be prorated, but that hasn't been made entirely clear yet. All right. I think the rest of the questions, most of the, they're pretty old, or we've covered a lot of these. So in that case, unless there's any more new ones popping up for people that are still here, we'll probably end up calling it a webinar and thanking everybody for their attendance. In that case, let's see here. Thank you both. Kind of a question here about state and local government grant funding. I think that's definitely more in your wheelhouse.
What is it? I've answered it a few times.
It's right at the, right now I'm just trying to go through any remaining questions that are popping up at the bottom, because those are people that are still here. So there's one that's popping up here about surplus and government funding, and that, I don't know if you want to take that one, or if it's too, it's.
You have to review, I don't know which one it is.
On the screen right now, if you can see it.
I can't, like I said, I can see my questions, I can't see yours.
Oh, okay. It says, since most of our programs are funded primarily by state and local government grant funding, we're likely to end up with excess revenue over expenses. Without PPP, we have faced significant loss. My question goes to first dollar. May we pay the full covered payroll out of PPP, then end up being able to claim less than state and local net deficit funding available on our contracts, effectively saving the state and local government, or to the extent that state and local government aid to meet funding of payroll, are we unable to meet or claim PPP loan forgiveness?
Okay, so basically you can use the PPP funds to cover the payroll or any other allowable costs. That doesn't make it forgivable, because you can use the funds to cover the allowable costs. From a forgiveness perspective, the forgiveness is going to be based upon the what is not funded by a governmental agency. So if you're already receiving funding from another governmental agency through a deficit funded contract or through a fee-for-service, such as early intervention services or any other Medicaid funded program, then you're going to be in a situation where the portion that is funded by another governmental agency, it's our opinion that those costs will not be forgivable, or should not be. You should not be seeking forgiveness for them.
Great, thank you. Okay, storage of records. So again, I said storage could be an allowable rent. I'm thinking more of storage of items than records. I think, again, there's not going to be bright lines on this. I think storage of records could potentially meet that. I also think you want to be more in a perspective of not trying to necessarily shove as many things in there as possible. What meets the overall purpose of this? I think storage of records probably is okay, though. We had someone quit on March 27th. Is that an exception? As long as you can document it, yes. This question about seasonal employees. I'm not as well versed in the seasonal calculation. I don't deal particularly with many seasonals. So other than knowing that they have some special rules and that the rules are ridiculously more complicated than the regular ones to a degree, I don't really have an answer for you on that one. I'm sorry. We got the money on on May 11th. Our payroll was May 7th through 2020, due 5/2022. Can I use the PPP loan for May 6th and 7th? So again, that's one of the questions that I think is still a little unsettled. If you go for the alternative period, you would start your clock on May 21st, even though you got it on May 11th. You can line it up going forward. I don't know if you can line it up for going in the past. Do any of the FTE exceptions apply if we go for the safe harbor? I think that's just gross FTE count on your June 30th day versus your base period. Our 403B employer contributions are paid on a quarterly basis. If we pay them during the 8-week period, can we get the full quarter forgiven or only the prorated amount? I would believe only the prorated amount because of payroll costs incurred and paid. When they talk about payroll costs, they are talking more about compensation than everything else. They haven't really spoken as much in regard to the other costs, but reading kind of between the lines, I feel like they want it to be an incurred and paid scenario. I think that's just more where the tea leaves are kind of falling on this. So I think it would probably be the prorated one. But some people are saying it's going to be the full amount. I don't think that's been. I think that's a point of debate right now. The alternative payroll is only an option for weekly or biweekly. Yes, that is correct. Ken, this one's for you. How to account for therapist salaries, which will be partially covered by the state. It is unclear how much the education department will reimburse since the full services cannot be provided.
That's a good question. Again, it's our opinion that if you are reimbursed for any expenditures, salary or otherwise, through a tuition rate or some other means, that you should not be applying for forgiveness for those. If you are in a situation where you're not sure and you're going to be filing, let's say, a consolidated fiscal report, a CFR, or some other document, and you can calculate and determine that you are going to generate a loss within that program, then it is possible for you, if you can show that that loss occurred during the 8-week period of time of forgiveness, it is possible for you to ask or request forgiveness for those losses.
Thanks, Ken. So the alternative payroll is not usable for semi-monthly, correct? We received on 5/1 and had a payroll that day, which covered the April 13th through the 24th. Is this when we start our payroll calculations? If you go with the alternative payroll calculation, you start your calculation on the first day of the next payroll period after your loan is dispersed. So if you paid it on, if you had a period of 4/13 to 4/24, you would then go to the period after the one that you received the funding on May 1st. So it's going to be paid and incurred is how it looks like it's going to be breaking right now. When do you think the loan application forgiveness will be due? I think that is a brilliant question. I don't think it'll be immediately after the 8 weeks, considering that the loan application documentation asks for some stuff around June 30th, and that hasn't even happened yet. So I think you're still a ways away from the application actually being due. I think this was just given out just to give people a sense of what the application is going to look like and to have a better way to guide some of their decisions. But I don't think you're anywhere near the clock for the application forgiveness yet. You don't have to move your pay date. This is one of the items that was covered early on, is you can have an expanded window that you can, any payroll that you incur and pay after your covered period, so long as it's by the next regular payroll date, will be forgivable. So you won't have to move your payroll date. All right, so I think with that, I'm probably going to end up calling it. I thank everybody for their attendance, those who stuck around. I hope I was able to answer as many questions as possible. A lot have really popped up, a lot more than I think I thought we're going to. But do appreciate everybody's time. Thank you very much, and have a great evening.